Stein Leasing Company agrees to lease machinery to Potter Corporation on January 1st, 2013. The lease term is 7 years and the machinery has an estimated economic life of 9 years. The cost of the machinery is $420,000 and the retail value is $560,000. The lease is appropriately accounted for as a capital lease. The lease agreement requires equal annual lease payments of $97,500 beginning January 1st, 2013. A $596 per year maintenance fee, executory cost payable to an outside service firm, is included in the annual lease payments of $97,500. Potter's, the lessee's, borrowing rate is 11%, and Stein's rate is 10%, which is unknown to Potter. Stein expects the machinery to be worth $80,000, and Potter guarantees a residual value of $75,000. Both companies use the straight-line method for depreciation. The requirements. Requirement number 1. What is the discount rate Potter should use? Discount rates. The lessor generally uses its own interest rate, and the lessee uses the lessor's rate if 1. The lessee knows the rate, and 2. The lessor's rate is lower than the lessee's borrowing rate. Otherwise, the lessee uses its own borrowing rate. In this case, Potter Corporation is the lessee. Potter's borrowing rate is 11%, which is greater than Stein's rate of 10%. However, Stein's rate is unknown to Potter, as it says right there. Therefore, Potter should use their own discount rate of 11%, even though Stein's, the lessor, rate is lower because Potter does not know Stein's rate. Requirement number 2. Determine the amount Potter should record as a leased asset and lease liability. To do this, you take the present value of the lease payments minus the present value of the executory cost plus the present value of the guaranteed residual value. That equals the present value of the total minimum lease payments. In this case, the lease payment is $97,500, and you use the annuity due factor, n equals 7 and I equals 11%, because we had determined in 1 that Potter should use his own borrowing rate. And the same applies to executory costs. You use the annuity due factor, n equals 7 and I equals 11%. And for the guaranteed residual value, it was determined that Potter guarantees a residual value of $75,000. So here, again, Potter uses their own rate, but you use the present value of $1 for n equals 7, I equals 11%. And then you get the present value of the total minimum lease payments to be $542,984.75. Requirement 3. What is the amount of sales revenue for Stein, the lessor, on January 1st, 2013? This formula is the fair market value of the leased asset minus the present value of the unguaranteed residual value equals the sales revenue. Since it's Stein uses, as we discovered in requirement 1, the lessor generally uses its own interest rate. So we use the present value of 1 factor for I equals 10%, or 10%. And so the unguaranteed residual value is the $8,000 residual value minus the $7,000 guaranteed residual value, $75,000 guaranteed residual value, to get $5,000 unguaranteed residual. And then so you get that the amount of sales revenue Potter should record is $557,434.20. Not asked in this requirement, but something we will need later on, is the cost of goods sold for Potter. And that formula is right here. And you get that the cost of goods sold is $417,434.20. Requirement 4. Prepare the appropriate journal entries for both Potter and Stein on January 1st, 2013 and December 31st, 2013, assuming the accounting period ends on December 31st. So here's the journal entries for January 1st, 2013 for Potter Corporation, the lessee. you debit leased machinery and credit lease payable. And you also debit lease payable and debit machine expense and credit cash. The machine expense is the executory cost that it was given to us. And here's it for Stein Leasing Company, the lessor, for January 1st, 2013. Also part of 4 is to record the journal entries for December 31st, 2013. So for the lessee, in order to do this, first you need to do the amortization schedules. And here's the amortization schedule for Potter and Stein. For the lessee, Potter, we already determined that the interest rates they would use would be 11%, their own interest rate. And Stein also uses their own interest rate of 10%. And so here is the appropriate journal entries for the lessee. They use straight line depreciation, and in order to determine whether to use the lease term or the economic life of the asset, the general rule is the lessee records the depreciation on the leased asset. If the title passes to the lessee at the end of the term, or the lease contains a bargain purchase option, the asset is depreciated over the asset's economic life. Otherwise, it is depreciated over the lease term. There is no bargain purchase option, and it doesn't say whether the title passes to the lessee, so we use the lease term of 7 years. And then here are the journal entries for Stein Leasing Company, the lessor. And those numbers we also got from the amortization schedules below. And that's it.